Welcome back, traders. I am on here with Matt Porzio, Vice President of Product Marketing at Interlinks. How you doing today, Matt?
Great. How are you?
We're doing okay. We kind of had an exciting morning here with the unemployment number and had some activity, but now we're going to switch gears here a little bit. And before we do that and we get into the interview here, could you just give us a little bit of your educational background and market background?
Sure. Yeah. So education, graduated from Colgate University with a degree in history and soon started in iBanking in the late 90s. Right after that, down in Charlotte. Spent some time in equity capital markets up in Baltimore. And then directly prior to joining Intralinks to build out this M&A virtual data room business here, I had worked for a German mid-market advisory firm called Metzler, doing cross-border M&A out of New York. And for the last 10 years, I've been with Intralinks on the other side, really changing how investment bankers do deals and leverage technology in deal making.
Okay, so you mentioned investment banks. Is that primarily who your clients are? Is it the brokerage firms, investment bank, private speculators, or who are pretty much the clients of your company?
Yeah, so our client base is pretty broad. I mean, if we just kind of define what Intralinks is, it's a trusted, collaboration platform for business professionals. And what we pioneered as a software as a service technology 16 years ago was this virtual data room concept that supported highly regulated, complex, strategic transactions. And so mostly, all the major investment banks are our clients and our users, but also all the major corporations that are active in the M&A or financial transaction world, whether it be debt capital markets, M&A. But we're also branching out into other areas where people are just using our platform to securely collaborate around their business. So we've got about 99% of the Fortune 1000 using our platform right now.
Okay, let's get right into the deal flow indicator. How long has it been active?
We've been doing this for the last 4 years. We recognize that as a leader in this market, we had a significant share of M&A activity, and we were seeing all these, early stage M&A deals about 6 months before they were publicly announced by a source like Thomson Reuters. And so we had this early view and this unique view into global M&A deal activity as it was just starting, as it was getting into that due diligence phase and leveraging our platform. And so, we had constant asks from, the bankers we were meeting with, well, what are you guys seeing, broadly, globally in the market, by region, by industry? And so we started producing that data. And if you think about it, it's analogous to how ADP payroll data, helps predict employment trends. It's at that same level.
Do you find there's a higher predictability by region or by sector?
Yeah, I think regionally, there's definitely, we've seen more consistency and higher predictability where the adoption of online due diligence or virtual data rooms is highest, right? So in more mature markets like North America, where we started the business, but also Europe, obviously, the usage of the technology and the adoption of that technology for deals, and even just the size and scope of those deals that go online, it gives you a little bit better predictability. But I'd also say in emerging markets like Brazil, where we're involved in nearly half of the announced deals, the predictability is proven out as well.
Okay, and are there seasonal patterns to it as well? I mean, now we're winding down to the end of the year here, and a couple months left before the new year. Is there obviously no one's gonna be rushing to get done, deals done by the end of the year? It'd be pretty quick, but have you noticed any seasonal patterns?
Yeah, as I mentioned, with that 6 month lag between sort of deals that start leveraging, technology and due diligence before they get announced, and that's an average, right? Some of the deals move faster, some of the hairier deals take longer, but since really the global financial crisis, which threw everything out of whack, we've seen what I would term the spring flood, right? Deals after everyone comes out of a bit of hibernation period in the first quarter. By mid-year, people are bringing deals to market with the anticipation of closing by calendar year end. So the last few Q2s, we have seen a significant uptick in sequential deal activity. We saw it again this year. And so, there's that flurry. And if you look at, like the Thomson Reuters announced data from last year, there was a significant sequential uptick in Q4 announced deals, which is what we saw in Q2.
Okay, well, you can't give us the secret sauce of the deal flow indicator, right? You got to keep that proprietary. But um, what what kind of role does social media play in this? You have the Twitter IPO, you have Facebook, and obviously these companies are making money by the data that they collect. Is social media play a role in your deal flow indicator, your predictability?
Well, it's interesting, and social media related to Intralinks and the use of technology and M&A is, information sharing is powerful, right? And social media is a powerful way to communicate amongst even business users. But at the same time, in the M&A world, right, you're trying to control the flow of information, especially in due diligence when you're talking about the lifeblood of a company, right? The information of employee data, projections, your strategy, that's data that people put on our system in due diligence to keep secured. Now, the truth is, if you look at some of the research out there, social media is being used today to leak deals, right? And some people in the industry believe that, leaking deals actually benefits valuations and actually helps create shareholder value by making sure, the processes run right, all the potential bidders know about it and can jump in. But at the same time, that use of social media, it can get quickly out of control, right? And it can jeopardize the negotiations on deals. A more important trend that we're seeing is what I would call social deal making. So we've got a network now of 2.7 million users, and we've got pretty much the who's who of the deal making community. And what they've always said to us is, right, we're kind of trapped in these virtual data rooms doing M&A deals. How can we interact through a secure use of technology? How do we interact only with the qualified people, not the broad LinkedIn groups with, hundreds of thousands of members who can't really talk about deals or help execute them. And so we built a platform recently that does that. It allows bankers to find more global buyers, and it allows the buy side to source more deals than they could from going to conferences, doing traditional meetings. It's just a way to accelerate that. So I think there's an intersection between social media and deal making that's happening right now.
Okay, is the deal flow indicator, is it a dynamic model? Are you constantly changing the components and tweaking it, or is it a static model where you have your inputs, you put it and you stick with them and follow the results from it?
Yeah, it's consistent in the sense of what we're measuring, that we see in the market, right? So it's deals that are, investigating using our platform, and they may choose another platform or ours. But we're seeing a significant portion of that deal flow, and we're just including, what we would call strategic transactions, asset sales, divestitures, you know, uh, early stage capital raises, joint ventures, those types of strategic transactions. And we measure that, that consistent set of data each quarter. And what we do is we show the sequential change in deal flow. And again, this is the volume or number of deals. And then we also show the year over year stats. So it's
Okay, and
pretty consistent.
going over, regionally, I mean, you cover the U.S. markets, or also, global M&A activity. We've had a strong year over year in the European markets, global activity. Do you think that's going to continue, or do you think North America is going to kind of pick things up next year?
Yeah, what we've seen over time, and if you look at our data, it tends to ebb and flow, and eventually, the global markets around M&A tend to balance out. Our most recent, our Q3 deal flow indicator showed Europe, in particular, having the highest year-over-year increase at 35%. What we saw sequentially is more of a leveling off globally, but a region like Latin America was the only region that we saw sequential growth in M&A activity. I think what you're going to see going forward is, yeah, you're going to see a lot more announced activity towards the end of the year in Europe. And what the trend has been is, as you see announced activity, deals beget more deals. People feel like they don't want to be too late to the party or miss out, so they tend to rush in, and then they realize that either the good assets has been already purchased or cherry picked, or valuation gaps are starting to increase again, and people don't have the right expectations, which means they will shift more to a region like North America or to even Asia Pacific.
And how are you? How is your business affected by our buddies there in U.S. Congress as far as the finaglings over the debt ceiling and stuff? Does that have a negative consequences for U.S. Activity as well as global deal activity?
Yeah, it's interesting. Anecdotally, my job's to be out there talking to our client base of corporate development heads and investment bankers and private equity individuals, and what they said is, listen, M&A is a little right now, at least the market is a little longer term thinking, right? We've got confidence returned, to those executives that, hey, I can't sit on my cash, my large balance sheets anymore. Interest rates are good right now. I've got to be in the market, and I've got to be looking to build long-term growth and do the inorganic growth route. So while it has an effect, I think it's more of a negotiation tactic, frankly, that we're hearing people use of why they might accelerate or slow deals or shave some numbers off the valuations that they're going for. But in truth, it's not going to stop the overall M&A market. It's going to take a bigger, longer sustained, what I would call crisis, to stop the trend of deal flow. All the fundamentals are there for a strong M&A market, and we're starting to see that in our business.
And that goes kind of the point that you made there about what to do with the cash. So, like when Mr. Buffett, takes out like a Heinz Corporation or something, is he looking at that as just there's a stable business, there's cash flow. He's just going to incorporate that into his portfolio for increased cash flow. I mean, because you can't you can't create new ketchup. I mean, they created that green ketchup and it didn't go over very well. Maybe for St. Patrick's Day. But what's he looking for in his deals?
Yeah, I think broadly, when you look at the motivations behind some of these deals, clearly some of them it's just there's a dislocation in value, and people want to try to extract that, and I think that's probably someone like Warren Buffett has done a great job over the years doing that. I think what we're seeing more though is less of these big deals driven by the ability to sort of just make money from the private equity investors, but more of a strategic M&A of people looking at regions, expanding globally, developing new product lines, right? I think while the Twitter IPO was a great success, there's a lot of companies, if you look at Twitter where they were 5-6 years ago, that are technology firms or even consumer products firms that don't want to go it alone either, right? They want an earlier monetization event, and there's a lot of cash and a lot of money out there willing to bring them into the fold and take that inorganic growth. And so I think the motivation of individual investors is something that's hard to predict why they're doing it, but I think overall the market wants growth, and M&A is a great vehicle for that.
Okay, and do you see much? I mean, U.S. companies merging with U.S. companies. Do you see much of an increase in U.S. companies looking to Europe for expansion, or vice versa?
Well, we've seen an increasing trend in cross-border deal activity globally. Really, everyone is looking beyond, and as I mentioned, as that social deal-making platform we've built, the reason is because people are looking beyond their own borders. I mean, what's interesting is we've seen a lot of, foreign investors and buyers looking at U.S. assets recently. We've seen a significant increase in the number of buyer participants making it in the due diligence stage, looking at U.S. assets. But the same trend, we saw, this big increase. I mentioned 35% year over year in EMEA. Those European deals, there's a lot of U.S. firms looking, especially large firms who don't want to repatriate some of the money they've made abroad. they're looking to just buy assets that are undervalued. Europe's been beaten down. The valuation expectations are more reasonable. And so US buyers are keeping money abroad and buying European assets. Now, at some point, all the good assets are sort of off the table, and I think you'll see a pullback. But that's what's driven that significant increase that we saw US buyers into Europe.
Okay, so let's get a little more stock specific here. You have a high flying companies like Facebook, Netflix, and now Twitter. And these companies, I mean, they got to satisfy Wall Street and they need to grow, right? So they have their internal growth, but are they going to look outside and perhaps go out and overpay for that growth? And that was a trend that we saw, and I don't want to mention it now, but we saw that during the dot-com bubble. Do you think these high flyers that are so hungry for growth and so hungry to please Wall Street that they're going to go out and overpay in order to get the growth?
Well, they've got to deliver on that growth, and but when you have valuations like we saw with Twitter yesterday, you can put capital to work, and I think for every Twitter, as I mentioned before, there's a ton of startups and Silicon Valley companies that look at the IPO prospect to not be what it used to be. For every one of those successful deals, there's a bunch that don't make it out, and probably should have sold out, to the Facebooks of the world earlier. And so I absolutely think you're going to see an increased trend of them buying, and when they all jump in the water, and they've got their stock as and cash positions to be able to go out buy companies, you'll see an increase in competition driving up valuations. I don't think it's going to get as out of control as it did in the past, but certainly you're going to see that. And I'll tell you right now, talking to our client base, some of these large tech firms, that were kind of sitting back and waiting, still doing their typical tuck-in, acquisitions here and there. They're ramping up, and they're even using our technology platform to plan and think about how they go after and target some companies that aren't on the market but should be.
And
So
does and this is overall. I mean, obviously you've been doing this for a few years, and you've seen the ebb and flow in the U.S. economy. So, like during the financial crisis, was it a ghost town around your office, with just people just all locked up? And then take it to the flip side now. The market's flying high. People are looking for deals. Twitter's coming to IPO. I think Steven Ratner tweeted out yesterday that if this is not a definition of another tech bubble, he doesn't know what is. Can you draw any comparisons on that, or is that really not fair?
Well, I mean, to address your first question about, as the financial crisis hit, things, the sort of traditional M&A route slowed down, but, certainly our business was buoyed by the distressed activity. It got to a point where people had no choice, and all the bankruptcy restructuring work, we were pretty busy. We were actually extremely
Good.
busy. And we helped with the bailout and the bad bank assets as well through the FDIC. But what's interesting is I think people hopefully have learned the lesson, and it's not too distant past that we probably won't get to that same level of craziness. But I certainly think some of these valuations are out of whack. I was just down in Houston speaking with a number of our energy clients, and they were saying, even for some of the midstream assets, pipeline assets that they're selling, people have rolled up, a bunch of little pipeline, 20-year-old assets and tried to bill it as a new pipeline and want 5x what they used to get. So it's not just subjugated to the tech industry. It's really everywhere where people are trying to make gold out of metal. So.
Okay, we've had Matt Porzio on here, Vice President, M&A Strategy and Product Marketing and Intralinks, and he is definitely giving us a well-rounded perspective on his deal flow indicator and merger and activity in the U.S. markets and also worldwide. Well, Matt, thanks for being on. Great information, and hope we can have you on again.
Great. Thanks for having me. Yeah, I'd love to come back.
Okay, have a good day.